Hey guys, what is going on? Welcome back to another YouTube video. Today I'm going to be sharing with you how to find the correct supply and demand zone. Just to let you guys know, before I get into the video, I'm going to be sharing what supply and demand zones are and what supply and demand zones look like. So if you already know what this is, just skip to chapter 1 and we'll go from there. So, what is a supply or demand zone? A supply zone is where traders and investors try to sell an asset for fundamental or technical reasons. It's essentially a range of price that is expensive or premium. And because it's so expensive, a lot of sellers come into the market expecting the price to drop, and therefore they'll make a profit. A demand zone is where traders and investors try to buy an asset for fundamental or technical reasons. So it's the opposite of what a supply zone is, obviously. It's a range of price that is inexpensive or discounted or cheap. Therefore, a lot of buyers come into this market because that product is cheap and they expect the price to rally upwards, to increase in price, therefore they'll make a profit. So that's the main difference between a supply zone and a demand zone. So this begs the question, what do supply and demand zones actually look like? Well, to be honest, there's quite a few ways. However, I have dialed down 4 main types of demand and supply that I think will help you guys. So let's get straight into it. Demand zones. Our first type of demand zone is the drop, base, rally. So all these different terms, they mean something and they're quite simple once you understand what it actually is. So I'll explain it with this diagram right here. So drop means a drop in price, a base is a sort of consolidation, and a rally is essentially price moving upwards. So we can see that there's a drop, there's a base, and there's a rally. So that is one type of demand zone, and generally price will come back, it will mitigate that demand zone, and then it will reverse again. Here we have an example from Euro USD, and this was actually a trade that I took. I've posted the full breakdown on my channel, so make sure you check it out, alright? Here we can see that there's a drop in price, and there is a base and a rally, and eventually price comes back down, it mitigates that zone, and then it reverses again. So that is our drop, base, rally type of demand zone. Secondly, we have rally, base, rally. So the only difference between this one and the previous one is the previous one was drop, base, rally. This one is rally, base, rally. So we essentially don't have a drop, all right? So instead of price coming down, which would be a drop, we have a rally. So we have a rally, and then we have a base, which is a consolidation, and then we have another rally. And then eventually price comes back down, it mitigates that zone, and then it reverses again. So here we can see the price was down here before. What do we see price do? Price pushed up, price rallied up, and then it consolidated, which is our base, and then it had another rally. And after that rally, what did we see happen? We saw that price came back into our demand zone, it mitigated it, and then it reversed off again. So that is our rally, base, rally structure. Supply zones. Supply zones are essentially the opposite of demand zones. So our first demand zone that we talked about was drop, base, rally. So the opposite of that in this situation is rally, base, drop. So here we can see that price rallied up, and then there was a bit of a base, and then price dropped straight down. And then what do we see happen here? We see that price came back in, it mitigated that zone, and then it reversed off again. And what do we see here? This is a live example again. We saw that price rallied up, there was a bit of a consolidation, and then price dropped down, and then eventually we got that mitigation and then another reversal. And the last but not least, we have drop, base, drop. This is my favorite type of supply zone that I personally like to trade. And this is when you have a drop, then we have a nice consolidation, and then another drop in price, and then eventually price will mitigate that zone and then reverse off again. So this example right here, it was actually quite recent. I can't remember which pair it was, but it did happen just a couple of days ago. What we saw was price dropped down, then we had a nice little consolidation, and then price dropped again, and then eventually price came back in, it went into the zone, it mitigated it, and then it reversed off again. So those are our main types of supply and demand zones and what they look like. So I hope that makes sense. So without further ado, let's get straight into it. Number 1, imbalance. Imbalance or inefficiency refers to price action where the wicks don't meet. This is something that we want. Whereas efficiency refers to price actions where the wicks meet. This is something that we don't want. So when I started SMC trading, I used to think, well, imbalance or inefficiency doesn't sound good, right? You would want to be efficient. You don't want to be inefficient. But that's actually wrong. When it comes to trading, you want inefficient price action. And I'll explain why that is. Because efficiency refers to there being a balance between the buyers and the sellers. Now, if we have a balance between the buyers and the sellers, that means that we don't have a clear bias or a clear direction where the market is going. That's why inefficient price action is bad, because there is no bias, and we want to be entering in markets where price is either moving upwards or moving downwards. Either way is fine, but it needs to move somewhere. That's why we want to have inefficient price action. The thing with inefficient price action is there is no real balance between buyers and sellers. In this example right here, with arrow moving upwards, right? So this is a bullish scenario. In a bullish scenario, the buyers are this strong and the sellers are down here somewhere. That's because the buyers are so much stronger than the actual sellers, that this creates that inefficiency and it creates that imbalance. So there's no real balance between the buyers and the sellers. Does that make sense? Whereas here, we can see that it's the other way around, right? The sellers are so much stronger than the buyers that price just keeps crashing down. And these wicks have no chance of, coming back up. So that's what creates that imbalance. So if we look at these examples, what we can see is this wick on top here, it doesn't meet the bottom wick right here. We have this little space. This is a fair value gap, and this is what we call imbalance. And this is where we want to be trading, because this means that not many orders in this area have been filled, because the market was so aggressive and it moves so strongly that there's a high chance that the price is going to come back into this zone and mitigate a demand zone. So whenever we're looking for demand zones, we should be looking for something like this. We should be looking for imbalance. We should be looking for inefficiency. Additionally, we can see here that this wick and this wick, they do meet each other. That means that this isn't inefficient price action. This is efficient price action, as we can see right here. That means that there is a balance between buyers and sellers, as I explained earlier, and we don't want to be entering in markets like that. It's just not good. Stay away from it. Just stay away from it. Okay? And here we have the bearish scenario. As you guys can see, this is the inefficient price action. This wick does not meet this wick. Therefore, it creates this little fair value gap here. And this is a good zone to be trading in because not many orders have been filled. Therefore, the market might come back in and mitigate this zone right here. Whereas here, we can see that this wick and this wick, they meet each other. Therefore, there's a balance between buyers and sellers, even though the market is moving down. That means it's just not a good zone and it's better to stay away from it and look for a better trade. There's always going to be more and more trades out in the market, guys. And all you have to do is wait for the right opportunity and pounce on it. Make sense? This brings us to number 2, liquidity. Now, liquidity is a little bit of a tough one, and let me explain what that really means. To understand this point, you need to know something about the market. Who controls the Forex market? The answer to that question is the banks and financial institutions. Their job is to move the markets in order to trigger more orders and to trigger more stop losses. And this is exactly why more than 95% of traders lose their money. It's because the banks are making them lose money. They're hitting their stop losses, they're blowing their accounts, and these traders don't have the right discipline and they don't have the right risk management plan. That's why most of these guys keep losing and losing and losing. Therefore, if we want to succeed in this environment, we must be looking to go against the majority of the traders. If 95% of people are losing in something, do we want to be acting like those 95%? Or do we want to be acting like the top 5%? You guys tell me. It's pretty obvious, right? We want to be in the top 5%. So we can do this by targeting their liquidity. We do this by targeting their stop losses. So let me give you an example of where we can do that and how we can do that. You need to understand that there's different types of liquidity. One type of liquidity is known as equal lows. The market generates equal lows, which induces early buyers into buying on the market because they think it's a support level, or because they think it's a double bottom, or it's some sort of key level that they think price is going to rally off of. However, these early buyers that come in at levels like this, they get stopped out because price retraces into a deeper demand zone. All right, and then it reverses. So this was, again, the same trade that I showed you guys before on the Euro USD. We can see that there's some minor levels of support here. There's some levels of support here. So a lot of retail traders are going to be buying on these levels because they're trying to make that quick dollar, and they're not really looking at the big picture. They're not looking at the imbalances here. They're not looking at all the demand that's down here, and therefore they get stopped out. And when they're getting stopped out, that's exactly where I enter the market, and that's where I make the profits. All right. So again, same thing. You got to think outside the box. You can't be like the 95%, because if you are, you're not going to be profitable. Straight up, you're not going to be profitable. All right. Different types of liquidity, right? The next one is equal highs. The market generates equal highs, inducing early sellers to enter the market on resistance levels or double tops or whatever you can say, right? However, these early sellers get stopped out and they lose all their money as price retraces into a deeper supply zone. So basically, it's the opposite of what we had for equal lows. For equal lows, we had equal lows and price retraces into a deeper demand zone. For equal highs, we have equal highs get taken out and price retraces into a higher supply zone. So here we can see that some early sellers would have been trying to take sells here. You can see that they're probably in profit here. Price came back up and they took another trade and they're in profit, but eventually price just takes their stop losses and it retraces into this deeper demand zone and then it reverses off again. Does that make sense, guys? There are more types of liquidity like trend lines and different trading sessions and so on. I want you guys to do some research on this and let me know what you find, okay? But the overall idea of liquidity is the market is a competitive zone, it is a very primal zone, and you're competing with millions of traders, literally. There's about 10 million Forex traders in the world, and you're competing with every single one of them every time you trade. So you have to think outside the box, and you have to go against the grain, all right? You can't be part of the 95%, you have to be part of the top 5%, top 3%, top 2%, whatever, okay? You can't be like the rest of them. And this brings me to my third point. When we're looking to target liquidity, what's another tool that we can use to enhance our trade setups? And that is the Fibonacci tool. The Fibonacci tool helps us identify discounted and premium areas of demand and supply. To make this simple, I like to use the fruit store analogy. I was talking to my friend about this the other day. I called him up because he wanted to know, like, what is Forex trading, bro? Can you explain it to me? And I explained it using this analogy. So let's create this hypothetical scenario, all right? There's a shortage of fruits in your city. Let's say you want to buy some apples. You can go to store A or you can go to store B. Both stores sell the exact same kind of apples. Store A sells the same apples at $5 a kilo and store B sells the same apples at $10 a kilo. Which store would you rather go to? And now this is assuming both stores are next to each other, so it's not like you have to travel heaps for one store and just walk to the other store, alright? Same distance, everything else is the same, the only difference is the price. Which one would you go for? $5 or $10 a kilo as a buyer? The answer is pretty obvious, right? You'd go for $5 a kilo because as a buyer, you want to be going for something that is cheap. Store A, as a trader, when we're looking to buy a currency pair, we want to buy it only if it is discounted. The Fibonacci tool helps us identify these levels. Similarly, let's say you're a shopkeeper and you're selling your apples, all right? Let's assume you will sell all your apples by the end of the day, regardless of the price, as there is a fruit shortage in your city. Would you rather sell apples at $5 a kilo, which is store A, or would you rather sell at $10 a kilo, which is store B? As a seller, what would you rather go for? What do you reckon? Answer store B. Pretty obvious, right? I mean, as a trader, when we're looking to sell a currency pair, we want to be selling something only if it is premium or expensive. The Fibonacci tool, again, it helps us identify these levels. So let's hop onto the charts and let's see if we can find this stuff, all right? All right, everyone, so now I'm on tradingview.com and I'm looking at the Euro US dollar on the 1 hour time frame. So here we can see that price is sort of trending downwards, all right? So let's see if price is retracing into our supply and demand zone. So what can we see here? We can see that price sort of breaks down, and then we have a rally, then we get this base here, and then we get another sort of lower low. So if we mark out this base, what can we see? Price came into this zone. Does that make sense? And what do we see here, guys? This is imbalance. We can see that this wick does not meet this wick. This creates a whole lot of imbalance right here. So we have a base, we have imbalance. Now we can use our Fibonacci tool. If you're on TradingView, the Fibonacci tool is known as Fib retracement. So choose that and then you can see that. So we pull it from the high to the low. And what can we see? We can see that price came into our golden zone right here between the 618 and the 786. Obviously, sometimes price is going to come up even higher, and that's okay. The higher the better. That means you're just going to get a better risk to reward ratio. But we can see that this base gets perfectly mitigated here and then price reverses off again. What do we see after that? we see that price broke down here, then we have another rally, then we have another base marked out by this doji candle, and then price reverses again. And what do we see price do? Price comes back into that zone, it mitigates it, and then it reverses again. So when we look at the Fibonacci tool, we can see that price has actually come into our premium zones yet again. It sniped the 786 and then it has reversed straight away from there. So you can see that you can't really fake this stuff, bro. It literally happens all the time. Now I'll give you an example of when it didn't happen. We can see that price came down here, then it had another rally, and then we had this base right here with a bunch of imbalance. Let's see what happens here, right? Here price came into our zone, but it actually broke structure to the upside. So in this particular scenario, it didn't work out, and that's completely fine. This strategy isn't always going to work, guys. It adds to your edge, and it adds to how you can, have better setups most of the time. Furthermore, let's have a look at some bullish scenarios. So what can we see here? We saw that price was trending downwards, trending down, and then we have this nice we have a bit of a break of structure here, and then we have this nice base here, and then price just rallies towards the upside. So we mark out this base, let me change it to a demand zone, and what can we see, guys? Price came straight into that demand zone and then it just flew straight off. If we use our Fibonacci tool, we can see that price came into our 618 and our 705 level right here. So you can see that it's these levels on the Fibonacci tool, they help us find discounted zones. So when we were looking at the sells, we were actually looking for premium zones. We were looking for zones that are expensive. Whereas when we look at buying opportunities, we're looking for price where it is discounted and where it is not premium, it's quite cheap. So these levels here, 618, 705 and 786, these are your cheap levels of price to buy from. All right. And what else do we see? We see another example right here, guys. We see that price comes down, creates a bit of a base right here, and then price goes up here. We can see a whole bunch of imbalance here, and then price comes straight back down, mitigates it, and then it reverses off again. All right. If we use our Fibonacci tool, this retracement was particularly quite deep. All right. 786. It goes past the 786. It goes into, I'm pretty sure, the 886 level. It snipes the 886 level and then it goes back up straight. All right. So that's how it works. It's that simple, guys. It's literally that simple. Obviously, it's not going to work every single time. As we can see, this zone right here was not respected at all. But again, remember what I told you about imbalance? Remember what I told you about inefficiency? What can we see here? What are these candles like here? There's so many big wicks. There's no imbalance here. There's no imbalance here. There's no imbalance here. That adds to your confidence in saying that, all right, I've got a zone here, but look at how many wicks it's presenting. It's not that strong. Therefore, I would rather stay out of this. I hope that makes sense, guys. So we looked at liquidity, we looked at inefficiency, and we looked at Fibonacci tool and how the Fibonacci tool can help you identify premium or expensive zones and discounted or cheap zones when you're buying. This brings me to my final point, and this is the most important point of them all, and that is practice. People say practice makes perfect. I kind of disagree. I've been trading for 2 years now, and I try and implement all the things that I just told you in every single trade, and I'm not perfect yet. However, practice will make you better, and practice is the most important thing in this game. You can know all the theory in the world, but if you don't go out there and you don't experiment in the real markets, you're not going to learn anything. All right. So I would say get a TradingView account. It's completely free, and start marking out your own charts. Try to look for imbalance. Try to look for liquidity. See how you go. Just have some fun with it. All right. And I'm sure you'll get better from it. So that's it for today, guys. Thank you so much for watching. If you enjoyed that video, leave a like, share, subscribe. I would love it. I'm a small YouTuber. I'm just starting out in this business, and I'll see you guys next time. Thank you so much. Have a good one.